Jeff Schneller, COO of Corby Mortgage, and today I'm going to talk about some options that contingent buyers have to go non-contingent. Oftentimes in the sales cycle, I'll issue a contingent upon sale pre-approval letter, and 3 or 4 weeks later, either the real estate agent or the buyer will call and say, I'm tired of losing homes, and what can I do? And so today I'm going to talk about a few options that buyers might have. So option 1 is to actually rent your current home. If you have a copy of a lease and a security deposit check, then the bank will not count that liability against you. They'll actually use 75% of that lease payment, and in most cases that's enough to omit that liability and you'll be able to go non-contingent. Another option buyers have is to use gift funds. So the rules have changed and you can use gift funds as little as 5% from a family member to put down on a house. Then when you sell your home, you will be able to put more money down, recast or re-amortize your loan, or just refinance it altogether. Another option buyers have today is by using post-closing possession escrow. And what that means is after you sell your house, you can rent back from the sellers for up to 60 days. So this way you can go close on your home and then go find a house and go non-contingent. Drawback on that one, of course, is you got 60 days, so you better find a house. But it is an option that buyers do have. One option that buyers often overlook is using an investment loan instead of an owner-occupied loan to get around a contingency. If you buy investment property, you can use market rent to help offset that liability. So if you found your dream home and the only way that you can buy it is contingent upon the sale of your home, perhaps you should look at putting 20% down and purchasing it as investment, then renting it out after your home sells. Another option borrowers have is by adding a CoSigner to increase their creditworthiness and make them non-contingent. It's better to get this done in advance and not Sunday at 7 o'clock at night, because we will have to pull credit on the non-occupant co-borrower, but this is a very common option and often, sometimes people just forget to use it. Another option that borrowers have is by using non-traditional funding sources, and that would be using a non-QM loan, which is not Freddie Mac, not Fannie Mae, not VA, not FHA, not jumbo, but something called a non-QM loan. And these have some unique features, and I'm going to talk about 2 of these features today. One of them is an alternative income documentation for a self-employed borrower. You can actually use business bank statements to qualify income. Oftentimes you're going to get a higher monthly income qualification versus using tax returns, okay? So if you've got a borrower that is self-employed and has to sell his home to buy, perhaps looking at a bank statement program is going to give them the leg up on the competition. The other thing that you can do with non-QM loans, and a little bit on the Freddie Fannie, but mostly non-QM, has really great asset depletion. And you can use your assets as income along with your either business bank statements or tax returns to get a higher monthly income, which again could move you from contingent upon sale to non-contingent upon sale. So in conclusion, maybe not every borrower is going to be able to take advantage of one of these options. But if somebody wants a home bad enough and they're tired of losing enough, perhaps this is a conversation we should at least have. And you as an agent, I think it's important that you at least explain or be able to explain some of these options, or at least direct them over to me so I can explain their options to give our borrowers the best opportunity to get their dream home.